This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, I'm Dan Coatsworth, and you're listening to the AJ Bell Money and Markets podcast. We've got some really interesting stuff to discuss on this week's show, comparing the UK and US retail sectors, what's going on with Nvidia, and why so few of us are using cash on a day-to-day basis. Joining me this week is Danni Hewson.
Hello, Dan. We've got two special guests this week. AJ Bell Chief Executive Michael Summersgill has had time to digest the recent budget from the government, and he talks to us about what it means for pensions and ISAs going forward. We'll also be joined by Jason Pidcock, an Asia-focused fund manager who still won't touch China, despite the flood of economic stimulus programs from Beijing in recent months.
Now, before we get to those, let's kick off the show with a look at the latest UK inflation figures and what they mean for savers, investors, and borrowers. So, Danni, what's been going on there?
Yeah, I mean, it was pretty well signposted that we would see an uptick in inflation. Anyone who living in the UK at the moment knows that the energy price cap went up at the beginning of October, taking our bills up by £149 a year for an average dual fuel bill. Obviously, the cap is on the unit of energy, not on the amount. So if you use more, you pay more. But that was the big reason behind the uptick in inflation, where we saw CPI go from 1.7% in September to 2.3% in October. Now, of course, alarm bells will be ringing because, of course, the Bank of England's target is 2%, and 2.3% is higher than the target. So a lot of focus has been on what potentially that means for interest rates, and I'll get to that. But sort of looking a bit further into the figures, it wasn't the price cap stuff which has really caught people's attention because, to be honest, as I say, we knew that was coming. We know that there is expected to be another jump in the energy price cap in January as well, which is not great news for inflation. But the things that caught people's attention were the core inflation numbers. That had ticked up a little bit, and the service sector inflation numbers had also ticked up. Obviously, despite the fact that the sort of narrative over the past couple of months is that the labour market seems to be relaxing a bit, wage growth has still been pretty high, above inflation. So, real term growth for a lot of people. And all of those things are filtering through to the service sector. Now, I think it's really important to point out that the changes to tax and spend announced by the government in the budget haven't had anywhere near enough time to filter through to inflation at the moment. And there has been concern, and certainly the Governor of the Bank of England, Andrew Bailey, said that if some of these measures are passed on to consumers in terms of price rises, then potentially this could impact inflation going forward. But just in terms of what it means for borrowers, for savers, immediately we saw the expectation of a further interest rate cut in December, which, to be honest with you, I don't know about you, Dan, but I was pretty sure there was no way that was going to happen following the budget. But expectation dipped even further following this inflation print. And we've already seen a lot of lenders upping the amount that they're charging for fixed rate mortgages because they're looking at what will happen over the next couple of years or however long you're taking out that fixed rate for, and they are pricing that in, and they're doing that ahead of time. But what was really interesting is the expectation of how many cuts to the interest rate are likely now to happen next year. What might happen with inflation? We've obviously got Trump tariffs. We'll talk a little bit more about the potential that might impact prices going forward. We had a warning from Walmart on that. But a lot of people, I think it was 50%, don't expect that we'll see a rate cut as early as February now. I mean, really kicking the can down the road. For savers, this should be good news. But I say that with a bit of a caveat because I've had an email from my bank just in the last couple of days playing catch up from the interest rate cut that was delivered by the Bank of England, saying that my savings rate would come down. So it's sort of a bit of a weird dance at the moment, I think. I know you spent a lot of your day talking about inflation as well. Was there anything else that stood out for you?
No, I mean, I guess on the sort of the savings account stuff is we know what banks are like. They're not quick to sort of to keep sort of savings rates high or if there's a or even put them higher, but they're very quick to change lending rates, aren't they? So it's poor old savers are left out. So yeah, I actually had the sort of same email from one of my banks as well, sort of saying things are going down. But I guess longer term, lots of people have been thinking that they're gonna, this is it for cash now. That you've had the best days have gone. Rates are trending downwards. Perhaps people are taking money out of cash, putting back into equities. I think now we've had this sort of shift in expectations. People might sort of saying, actually, maybe I will keep some money in cash after all, and just see where things go. See if but yeah, I mean, it's we obviously we talk about shifting patterns on the podcast quite a lot, and once again, things are changing, aren't they?
Yeah, volatility has been the word. Forget manifest, which I think is the word of the year. I think for me, volatility again is the word of the year again. Um, and I think we certainly seeing some volatility on markets. Obviously, what is going on, Russia, Ukraine, also potential for changes when Trump gets into the White House. There's been a lot of talk about tariffs, and tariffs are certainly something which could impact the US chip giant Nvidia. And it has just published its latest results, and lots of people own this stock directly or have exposure to it in investment funds. So it is really important to stay across what the company is saying. And it felt kind of weird, almost counterintuitive, because on the one hand, the results were good, but on the other hand, shares fell because they weren't quite good enough.
I know this is a weird one because this is like 8 quarters in a row. The company has now beaten expectations for earnings and revenue. The commentary was really bullish, really exciting about opportunities ahead. And I think to the average person, you might think, okay, well, that's surely the kind of thing that would drive up a share price. But actually, no, the shares are down sort of 2.5% in sort of soon after these results came out. I think what we've got here is that, for the last couple of years, people have been focused on the big picture with AI. So, lots of companies around the world are now using AI, and Nvidia's sort of chips are central to that. The big demand for its products, and so they've had this big picture has been driving up Nvidia's share price. Now people are looking at the sort of the minute detail across the business and asking more questions. I think they're becoming more familiar with what the company does and each of the sort of different parts of it. And I think that sort of closer look at what they're doing means that investors are quick to spot when there's areas of disappointment. And here with these results, there's two things that trouble the market. One is that the sort of guidance for revenue for the next quarter perhaps wasn't as strong as people were hoping. But there's also, in the latest results that have just been announced, a slight decline in margins, and Nvidia's guided for those margins to fall a little bit further as well, as we move into 2025. Yeah. These margins are still way higher than you find at most companies, but we have got little things here for people to grumble about. I think the big things you're going to watch next year is that Nvidia is really, really dominant in this market. Will the competition authorities saying it's too dominant? What about everyone else? And there needs to be fair sort of opportunities here for other people to compete. And of course, the other thing is, what will Donald Trump do with relationships with China? They're not very good at the moment. US has a sort of a ban on selling the most advanced chips into China. You wonder whether it will now sort of impose even greater restrictions, which could impact Nvidia, because it currently does sell older chips into China. And I wonder whether that might be another sort of stumbling block for the company going forward. But yeah, it's you know, As always, lots of exciting things to say about AI, though. I mean, this opportunity is huge, and if you go and read what Nvidia's been saying, and it thinks it's going to last for a very long time.
Yeah, I mean, it's a fascinating space, isn't it? And investors have got really excited about the potential for AI, and we're seeing that in terms of company earnings. There are an awful lot of companies that are doing incredibly well because of AI, but we've also got an awful lot of companies that are spending an awful lot of money on AI to try and stay at the forefront. But if you don't do that, then you lose your position. And Nvidia certainly doesn't seem to be in any danger of losing its position at the moment, but it is spending a lot of cash.
Yeah. So, I mean, there's been a lot of if we shift to another topic, there's been a lot of grumbling from heads of UK high street companies following the budget. And this week, the government was presented with a letter from some of the country's biggest retailers. So, Danny, what's been going on here?
Yeah, I mean, it made quite a splash because when you've got names like Tesco, Boots, Marks and Spencer, Next writing to the Treasury warning that the measures which were implemented or about to be implemented from the budget will impact them to a mega degree. I mean, they were warning of a £7 billion hit from those budget tax rises, obviously the change to national insurance, particularly the lowering of the threshold, because a lot of retailers and hospitality in particular have huge staffing numbers. They employ a lot of people that work part time. And the BRC letter warns that this impact coming so quickly, coming at the same time as other changes, like an increase to the national living wage, like changes to business rates, like the implementation of packaging tax, all of those things together mean that a lot of these companies are really struggling to sort of plan for the changes. And they've warned that, look, there are two ways that this can go, really. They can't just absorb this huge hit coming as quickly as it does. So they're either going to have to pass on these tax hikes in the form of higher prices to all of us. And of course, that is something which will then impact inflation, or it will have to look at job cuts. And if you think it's just saber rattling, what was really interesting to note is that the governor of the Bank of England, Andrew Bailey, did say that he thought these retailers had a point, that it was likely to result in job cuts. And we have already seen a number of businesses saying, look, we are going to have to put up prices. And I'm not just talking about retailers, I'm also talking about hospitality as well, because they're very much in the same boat. And we've also had UK hospitality sending a letter to the Treasury saying something very, very similar indeed. And we've heard that, there was a huge cheer. We talked about this, the penny off a pint. Well, we're already hearing from the likes of Timmy Taylor's that actually, no, you're not going to have a penny off a pint. You're going to be paying a lot more for your pint because of these changes. And I've heard a lot of people say, well, look, they make a huge amount of profit. Why can't they just absorb this? But you were just talking about Nvidia's margins. When you're talking about hospitality and retail, you're talking about much smaller margins. I mean, sort of typically between 3 and 5%. So it's not really possible to absorb. They do have shareholders that they need to think of when they are dealing with all of these changes. And a lot of people, as you were just saying, people have funds with Nvidia in. Well, a lot of people have pension funds that have some of the big supermarkets in, some of the big retailers in. So they have to consider that as well. So I think the fact that we are hearing calls for the Treasury to maybe soften it a little bit, maybe to bring down the amount of national insurance that has to be paid on that lower threshold. So where the change comes in, if they can start paying a slightly smaller amount, that could cushion the blow a little bit. And Begbie's trainer was also saying that he does think that more businesses will come under a great deal of duress, and this warning that businesses could close. It's not just, saying it to make a splash. This is something which potentially could really happen.
Now, we're already seeing signs of companies sort of saying, we've got to make really big decisions here. So just this week alone, we've had Morrison's come out and say almost 400 workers are facing redundancy. It's part of a plan to close one of its bakery operations. And Summers having to cut jobs. It's not doing very well on the high street. And it's not just retail. Lots of other consumer-facing companies are having a really tough time here. Ford has come out and said it's going to cut 800 jobs in the UK. That's part of a broader program to cut 4,000 jobs across Europe, and that's down to increased competition, weak electric car sales, and just sort of general economic challenges. And even it seems like we're not buying enough Kit Kats. Nestle, the Kit Kat owner, it has already announced a 1.1 billion pound sort of cost savings spree. It's now come out and said it's going to increase that by another 2.2 billion. But interesting here, this is not expected to be sweeping job cuts. It's actually looking for some more efficiencies in the company, better ways of buying things. But I think generally it's not really looking that great at the moment for consumer facing companies in certainly in the UK. Over in America, we've actually had quite a few big name retailers report this week, and of course that's really interesting. Whilst you're thinking, okay, well, I'm really concerned about what's happening at home. You should be understanding what's happening overseas as well with the US, because the US consumer can tell us a lot about the state of the world. So, Danny, what are sort of some of the key things that these big name retailers have been saying in America?
Yeah, I mean, the US consumer, if you think about the number of UK companies, European companies that sell stuff to the US consumer, it is massive. And we have seen sort of the impact of disappointing retail sales over the last year or so, making an impact over here. The last lot of retail sales actually looked a little bit brighter than I think a lot of people had expected. And this will perk up car makers' ears because it was car sales in particular and electronic items which sort of boosted retail sales in October. Now, we know that just like here in the UK, the US consumer has also been hit by high inflation. So although we talk about the fact that US markets have been, well, more than resilient, and we talk about the fact that the US economy has certainly demonstrated it's more resilient than the UK economy. I mean, their growth has far outstripped GDP growth here in the UK. The US consumer is still feeling it. I mean, that is one of the reasons that Donald Trump really swept the boards and got into the White House, because he kept saying to people, how do you feel? Do you feel better now than you did before or not? And if you don't, well, then, maybe elect me back in. And that is exactly what happened. People were indeed talking about the economy. Stupid. We have had a couple of those really important big box retailers. We talk about the fact that Nvidia can move markets. Well, a couple of these big box retailers can also move markets. And Walmart, I think, is a key example of that. And it has outperformed. I mean, we're talking about 9 consecutive quarters where it has delivered over the odds. And I was looking at some of the numbers, and its stock is actually set for the best year since 1999. So up 60% so far this year. And it delivered another crowd-pleasing set of results. And it's once again boosted its expectation of what it is going to deliver over the next year. So forecasting sales somewhere between 4.8 and 5.1%, as opposed to 3.75 to 4.75%. So it is going great guns, but it is very much focused on delivering value, but delivering value to those sort of higher and middle income shoppers who are trading down. So they have taken advantage of that. And because of that, they are doing very well, because I think it's fair to say that the lower end of the market, the consumer that has less money, that earns less, is the one that seems to be impacted the most. We've seen it in, some of the results from the likes of McDonald's and Kentucky Fried Chicken. Well, Walmart says it is seeing that in some of these areas, the consumer that maybe is the middle income or the higher income that has changed habits and is now shopping at Walmart, they're feeling a bit better. So they're actually now able not just to spend on food and stuff, but they're looking now again at discretionary stuff. But it's not across the board. And as I say, the value end is struggling. And I think you have certainly been looking at a couple of other names which haven't done as well.
Yeah, I mean, one of them is Target. It's basically its share price absolutely crashed this week when it came out with really gloomy set of earnings figures. Essentially, is it pointed to weakness in stuff that wasn't essential for everyday needs, and so I think people have been looking at Target and thinking, okay, it's not been doing very well, and it seems to be losing out to one sort of rival in particular, and of course that's Walmart. Walmart is taking business from it. So during the pandemic, the company did very well. People rushed to sort of decorate their homes and stock up on sort of essentials, but come sort of by the sort of about 2022, that sort of trend has sort of played away, and people were really watching their pennies, and so even though Target is aimed at sort of the value end of the market and the lower income sort of shopper, it doesn't mean to say it's doing very well. And interesting, it's not just a blanket case of the real bottom end is struggling. Those serving sort of the middle class is doing better. We had TJX, which in this country you'd know it as the owner of TK Maxx. Obviously they got different price points, but they some of them stuff for sort of cheaper end, some sort of middle end. They actually raised earning guidance, so I think it's sort of perhaps it's on a company by company sort of basis in terms of what's being who's doing well and who's doing not. But it does. It does tell you a lot about all these sort of constant moving parts in the retail sector. And if you think that the UK is sort of having sort of divergent fortunes in terms of its retailers, the US certainly is in that situation. I know, no, so Danny, I know we've been talking about sort of the budget in the UK a few times so far on this episode. Actually, but there's just one more area I did want to sort of just include in this podcast. So even though the budget is now in the rear view mirror, many people, including investors, are still trying to get to grips with what it means for them.
Yeah, that's right. One person who is acutely aware of the challenges that it's created is Michael Summersgill, Chief Executive of AJ Bell. Dan, you were lucky enough to sit down with Michael the other day. Let's play that interview now.
Well, I'm delighted to be joined now by Michael Summersgill, Chief Executive of AJ Bell. Michael, thanks ever so much for coming on the podcast.
Pleasure. Nice to be here.
Good. Well, let's talk about what's been going on in the last few weeks in the UK. I mean, we had the budget. There's certainly a lot of speculation ahead of the event, which caused a lot of investors to worry about what might happen to pensions, what might happen to tax. And then the budget came out, and it didn't quite seem as bad as feared, but there were some areas in there which gave pause for thought. I mean, what's your sort of take on what was actually announced in the budget?
Okay, so I think if you break it down, if you look at the world of the retail investor, if you think about the financial services industry, there were some big moves that were feared ahead of the budget that we escaped. So there were concerns around restrictions being placed on tax-free cash being taken from pensions. That didn't transpire. So there was perhaps we avoided the worst of what was feared ahead of time there. But if you look at the budget more broadly, I mean, it was a historic budget in terms of the tax raising efforts. I look at it from AJ Bell's perspective as a relatively large employer, and I look at the national insurance contribution changes, and they are punishing. No doubt about that. So. Whilst expectation management is important, perhaps they did a good job of creating some real deep concerns ahead of the budget, such that we came away from it thinking, oh well, we've escaped without X and Y and Z. But make no mistake, it was an aggressive and punishing budget.
I mean, one of the things in there was that pensions are going to be subject to inheritance tax. Did that take you by surprise that we had that news?
I don't think we can say that it took us by surprise because, as I mentioned before, there were lots of things being discussed ahead of the budget. The rumour mill was in overdrive, and IHT on pensions was one of the things that was discussed. I was more concerned about the removal of what I see as tax deferral on contributions on pensions on the way in. That tax is ultimately paid, but it's paid on the way out. I think that's the backbone of the pension system, and to make changes there would have been very damaging. And also on the ability to withdraw some cash tax-free when people go into retirement. That's a long-standing benefit of pensions and highly, highly valued. They were the two areas of greatest concern. But the change of the treatment of pensions on death was always a potential risk. It's certainly one that, having looked at the proposal, is a major concern. Not just because of the tax that's being levied. Look, those things are it's elections and it's MPs who decide the political direction of the country. There's a clear mandate for this administration to raise taxes to spend on public services, whether I think that's right or not. But you look at the tax that's being raised there, and because there are two layers of tax. There is the inheritance tax that's being implemented, but because of the way that they're doing it, there's then also income tax to pay as well. So there's been different examples doing the rounds of certain estate and pension scenarios that can result in an increase in the tax take of circa 90% of the value of the pension. Whilst those are factually correct, they're very specific circumstances. I think more the sort of the realistic figure that people should have in their mind is 67%. If there's no nil rate band on the inheritance tax to apply to the pension, and you've got somebody who is an additional rate taxpayer or becomes one as a result of receiving that pension inheritance, then 67% tax is what they will pay, and that is aggressive. My other major concern about it is I think it's actually inoperable in the way that it's being proposed from the perspective of a scheme administrator. I cannot see how the information flow between the estate and the pension scheme works. So I think that there's some real dialogue with Treasury and government required there.
A lot of people seem to be pretty annoyed around sort of the lack of clarity on the sort of the broader pension system. Do you think that the government should ultimately just stop fiddling with the rules? Because I think surely there must be a benefit if everyone knows what's going to happen to the pension system, how things work, and it's going to stay like that for years to come.
Absolutely. These are decisions that people are being asked to make over a period of decades. 20, 30 years, people are contributing to a pension, knowing that they will be subject to the income tax rates of the day when they are pensioners and they draw that money out. But to have serious doubts around the ability to make those contributions, the tax treatment of those, and then of the pension benefits they ultimately look to draw, hugely damaging. And as a society, we don't invest enough. We don't contribute to pensions enough. We have this pension savings gap in the UK. And so that it's the same as in anything in life. If you create uncertainty, you create instability, then making decisions, particularly long-term ones, becomes very, very difficult. So I think it's hugely damaging, which is why ahead of the budget we called for a pensions tax lock to try and bring that stability about.
There wasn't a lot of news on ISAs in the budget, but if you bury into the document, there was a sort of a reference saying that the allowances will be frozen until 2030. Do you think that's a missed opportunity by the government to sort of simplify the ISA system?
I'm hopeful that ISA simplification will follow. I didn't have high expectations for this budget in that regard. I thought that had been signposted by the government reasonably well, to be fair. What we did see was confirmation that the UK ISA will not be brought into existence, which I think is a positive because it's a step in the wrong direction. ISA simplification, there have been commitments made about that, but we need to see progress on that in the new year. It's something that, again, trying to get more people investing, it's a great tool that we can use as a society to do that. ISAs are a very trusted brand, but the landscape is far too complex at present. We have 6 ISAs, 5 active ISAs effectively, and for people to navigate and to choose between them and make sure that they are getting the right outcome for them is far more complicated than it needs to be. So whilst there was nothing in the budget, and I would agree on the one hand that there's a missed opportunity there, I would have some confidence that will follow in the new year.
Brilliant. Well, Michael Summersgill from AJ Bell, thank you for joining us.
Thanks very much to Michael for sparing the time to appear on the podcast. Right, let's talk cash. Do you still pay for things with coins and notes, or are you completely dependent on cards or your phone?
Well, I think that's a question lots of people have been asking, isn't it? So I think I only actually use cash to get my hair cut. Otherwise, I can't think of any need to use cash at all these days. Even the kids, when they want some, want to go to the shops, they're always saying, can you transfer it electronically? I don't want to carry around notes and cards and sorry, notes and coins and stuff. So, yeah. What about you, Danny? Are you still clutching your fivers when you go shopping?
No, I very rarely have cash on me, although there's a couple of things that I currently have to pay for in cash. So my daughter's driving lessons, and the chippy up the road doesn't have a card machine. So if you want a chippy tea, then I'm afraid you've got to go with cash. But what you say about the kids, my kids get tips from their work, and they get them every month, and they get a little envelope. They get paid electronically, but they get their tips in cash. And the first thing that they do is bring it back and say, can I give you the cash and you can transfer it over to me from your bank? But I think that is kind of across the board, particularly with COVID, lots of us did get used to using cards. And I know in some places you go on the train, LNER, I go from Wakefield to London quite a lot. And there you can't use cash if you want a cup of tea. You've got to use your phone or your card. But we also know that because we've had this cost of living crisis, and I know we're not seeing the headlines anymore that we used to see, but I think a lot of people are still struggling. And for them, cash is a really useful way to budget because you can see it. And when it's gone, it's gone. Whereas sometimes it's way too easy just to tap, tap, tap and not have any real idea of how much you spend. But we know that even though we're relying on digital payments, 3/4 of us are still carrying emergency cash, that just in case fiver that you tuck into a corner of your wallet. And the research, which has been carried out on behalf of NatWest, has found that 8%, 1 in 12 people, actually still use cash all the time. And it was interesting because they sort of dug into that a little bit. And I know that does tend to be those people who are wanting to use it to budget. So you do understand because it does make life easier. But they also said that maybe if there was better fraud protection, they might consider using alternate means more often. But I think the issue of cash is really interesting.
Yeah, I mean, there's a few things which caught my eye as well. What one this week is that big issue vendors are going to be um, basically given the sort of the technology to so they can accept card payments for their magazines, and that's a real sign of the times, isn't it? So 'cause I often feel sorry for them. You walk around the high street and they're sort of saying big issue, and people go, "Well, I haven't got any change with me." Of course, now that I'd like to see that would this change will result in obviously more money being sort of raised through big issue vendors that way. But there was a report out over the summer, which from UK Finance, just looking at sort of trends with payments, and it said that 4 out of 10, almost 4 out of 10 payments in the UK last year were made using contactless methods. And this is extending into mobile wallets. So lots of people using Apple Pay and Google Pay. Of course, this is younger people are definitely leading the charge here. But UK Finance said it did expect older age groups to sort of catch up over the coming decades. But what the really interesting stuff is, it gave some projections about what it thought. Okay, 10 years into the future. So obviously, its original report was based on 2023. So it's looking at what could happen in 2033, and it thinks that debit cards will reach 31.1 billion payments. That's versus 24.5 in 2023. But contactless debit and credit card payment volumes will represent 45% of all payments made in the UK. Cash use will continue to decline to 6% of payments, and poor old check. I mean, I was going to say, at the moment, checks only account for 0.2% of payments in the UK. That's going to halve, according to UK Finance, to 0.1% predictions. I mean, it does make me chuckle. Imagine, can you imagine a child receiving a check for Christmas in this day and age? What they just look at it and go, "What is this? Is it like Monopoly money or something?" But
I don't even know where my checkbook is anymore. And that's so weird, isn't it? Because it used to be something that you would probably use a couple of times a week. And it just demonstrates really how habits will change. And what you said about big issue sellers, I popped into a Sainsbury's the other day and there was somebody outside from a charity saying, I'm raising money for Christmas. And I said, "Oh, I don't have any cash." And they said, "That's okay. I can take card." And for me, it was just like, wow, well, it makes sense because I would imagine so many people, exactly as you said, just say, I don't have any cash. It is time for our final guest. Asia can be a fruitful place to find attractive dividends. And Jason Pidcock from Jupiter Asian Income Fund has been investing in the Asia Pacific region since the early 1990s. So he knows a thing or two about finding winners and avoiding duds. Dan recently met up with Jason to talk about the hunt for income, his thoughts on China, and why a Trump victory puts the spotlight on one of the most important companies in the global semiconductor supply chain. Let's hear that interview.
So I'm joined by Jason Pidcock, who is the manager of the Jupiter Asian Income Fund. So Jason, thanks ever so much for joining us.
Thank you.
Now, you made the headlines a couple of years ago talking about you no longer investing in China. Now, obviously, is that still the case now? Only the reason I ask is because we've obviously just had a big stimulus program. Chinese equities have enjoyed a bit of a rally. Does that sort of interest you again?
No, we don't buy into rallies because we tend to find that with China, at least over the long term, they tend to peter out and don't come to much. Chinese equities have been dreadful performers over the last 30 years. They've been certainly one of the worst performing markets within the region and indeed globally. But every now and then there will be a sharp rally. We don't get excited about those, and we do think there are a lot of challenges for China, politically as well as economically, and so we intend to stick with our zero weighting for some time to come. That probably means years rather than months. There are plenty of other markets in the region that we're comfortable investing in. We've seen that the incoming Trump administration is likely to be quite hawkish on China, with Marco Rubio having been appointed as Secretary of State, Pete Hegseth as Defense Secretary, and Mike Waltz as National Security Advisor. So with that and the likely raising of tariffs on imports from China, 2025 could be another tough year despite the stimulus measures.
What sort of yields can you get from Asia, and how does that sort of weigh up against other parts of the world?
So we are putting together a portfolio yielding roughly 3.5%. We've got a number of companies that yield more than 5%, but we do have lower yielding companies where we're expecting faster dividend growth over time. So the sweet spot is that range 3 to 5, I would say. That is higher than most other parts of the world. The US is yielding roughly 2%. One of the high yielding markets in my region, Australia, yields about 4%. And it's certainly a higher yield than you might achieve in Japan and a number of other European and emerging markets. So we like the yield today, but what's at least as important as that is prospect for dividend growth, and that is something that we do continue to find in many markets in Asia.
So you've got about a third of your portfolios in tech companies. Now, tech is not really historically sort of been associated as a place that you get dividends from, or certainly high yields. But we are seeing companies, particularly in the last couple of years, starting to, big tech names saying we're going to start paying dividends. That surprises me because I'd thought that, as a sector, they're always trying to invest, try and stay on top of technical innovations, and there's always sort of a demand for their cash. Why are these companies now paying dividends?
Many of them do have high capex levels, but they're very profitable and they have very strong balance sheets. And the stocks that we invest in, they've been paying dividends for years, unlike tech companies in America and many other countries. So as a sector, it's been a rich source of dividend income and dividend growth for us for a long time. This isn't new. And some of the key companies that we invest in have been growing their dividends quite steadily recently, and we're very confident of dividend growth in 2025 and 2026. So I guess the key is having that strong balance sheet, high enough margins and high enough returns that you can generate enough cash to be able to invest for future growth, as well as share some of your profits with your owners, i.e. pay dividends.
So in your portfolio, you've got TSMC, which is the Taiwanese semiconductor manufacturing company. So it's a very popular name with lots of fund managers. It's seen as a very, very sort of a big, good track record business. But clearly, with Donald Trump winning the election, does that sort of essentially put TSMC in a difficult situation? Because you've got China has been threatening to invade Taiwan. Donald Trump, during his campaign, was been talking about, asking Taiwan to pay the US for sort of defense. So I'm just wondering what would happen, if something bad happened in Taiwan, either because China invades it or there's tensions between the US and China. Surely that's going to be bad for TSMC.
Well, the position of strength that they have is that they're extremely good at what they do, and the world absolutely relies on their output. Many US customers like Nvidia, Microsoft, Amazon, Apple, Google do need TSMC. They wouldn't be able to function if TSMC's operations was to suddenly shut down. TSMC has been diversifying its manufacturing capacity, is opening up plant capacity in the US, in Japan, and is going to in Germany. But for now, at least 90% of their sales by value are coming from Taiwan itself. This does help make Taiwan strategically important, and we think means that the US will make sure that Taiwan is defended if necessary, because it would be terrible for the US economy if Taiwan were to fall into the hands of another country, or for something to happen which meant production got shut down. Now, that doesn't mean there is a zero risk, and we do follow this very closely. But if an event happened which caused production to cease in Taiwan, that would be catastrophic for the whole world, for the global economy, not just for Taiwanese equities. Taiwanese equities do have an element of a discount priced into them already. So if, hypothetically, China were to come out tomorrow and renege on their territorial claims for Taiwan, we think Taiwanese equity prices would go up substantially, suggesting that there is a discount in the price. Whereas for US customers who rely on supply from Taiwan, we don't think there is any discount in their price for that risk. So it's something that we follow by having a zero weight in China that offsets the risk of being overweight Taiwan. And stocks that we own elsewhere in the region, we have a defense company, we have a gold miner, we have some basic consumer staples businesses in countries like India that ought to be relatively defensive. And then the final point would be that, as well as TSMC, we own other Taiwan tech stocks, but they are the largest companies in that country, in that market, and the most liquid. So if we did change our mind, if we thought the risks over the next 12 months were uncomfortably high, we could sell out relatively easily.
Yeah. Well, where else are you sort of finding opportunities at the moment?
There are 4 key markets for us. The bulk of our portfolio is invested in Australia, Taiwan, India, and Singapore. No other market has a double-digit weighting in our fund. So those 4 markets are absolutely key. And between them, we've got, we think, all bases covered. So we've got strong domestic demand in a relatively closed economy in India. We've got globally competitive businesses in Taiwan in a specific sector, tech. And then in Australia and Singapore, we have a mixture. Companies playing domestic demand growth, but also regional and global growth. But we have companies that we consider to be good value. They have strong balance sheets. They have liquid shares. And we think they will deliver growth over time. So we're very excited about these 4. And we think the risk-reward trade-off in these four remains very, very good.
How about the outlook for next year then? Obviously, with people's minds are sort of focused on sort of shorter term things. Are you feeling sort of quite confident going into the new year?
We are feeling confident. Now, there's always a danger that may be misplaced because new events can occur, which can take everybody by surprise. And we had events early in the years of 2020 and 2022. But if there's no black swan event, we are quite confident of decent earnings growth from a lot of the businesses we own, particularly in the tech sector, but others as well. So we do think that will translate into dividend growth. We're not as concerned about a pickup in inflation as some people seem to be. That's not to say it's going to go back to historic lows and stay there indefinitely, but we do continue to believe the trend for interest rates is going to be lower. So there is a lot to look forward to, but absolutely we do have to be aware of the risks, and what we try and do is minimise unnecessary risk in everything that we do.
Well, Jason Pidcock from the Jupiter Asian Income Fund, thank you ever so much for joining us.
Thank you.
That is all from us this week. Don't miss next week's show, where we've got two fund managers talking about generating an income from your investments and looking globally for smaller company opportunities. Until then, thanks for joining us and have a lovely week ahead.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.